Thinking about buying a home but worried about high interest rates and inflation? Don't stress, because in this video, I'm going to be breaking down how to strategically buy a home in today's market, even with inflation running at all-time highs. I'll walk you through some smart moves that people are taking right now to protect themselves and to build equity. Let's get started. So let's first talk about how inflation impacts the housing markets, and we'll start with mortgage rates. When inflation is high, the Federal Reserve raises interest rates to cool the economy. So let's think about this. Higher rates equals higher monthly mortgage costs, which equals lower affordability. Make sense? But there's a flip side of this. As rates rise, buyer competition falls and prices often stabilize or even drop slightly. So let's think through this. Most buyers don't understand that there's more than just your interest rate. So what they're going to be thinking is, all right, higher interest rates mean a higher monthly payment. And if you're on the selling side, understand that you may have to drop your prices or be a little bit more conservative, not be too greedy, still get a good price for your house. And if it's not good enough, maybe you have to wait for the interest rates to drop back down and get more buyers to come into the market to pay you a little bit more if the value is there. So high inflation periods can actually create buying opportunities if you play it smart. I put together a step-by-step strategy to buy in a high inflationary market. Let's break this down. Let's first focus on long-term value, not short-term rates. There's a lot to be said in that statement, so really think about that. Inflation periods come and go, but your home, now that's a long-term asset. Rates are temporary, and you can refinance as they drop. We all know this. Prices, however, rarely return to pre-inflation levels once demand rebounds. If you don't understand that, think about COVID. What happened after COVID? Prices didn't just dramatically come back down to where they were before COVID. No, because houses sold, it raised the value of houses, right? So now there's a new normal for a house. Let's take a hypothetical scenario. Say a house pre-COVID was in a normal market selling for $200,000. Hypothetical numbers. But after COVID and all the homes that sold, now the normal median for that house is $250,000 because of all the other homes that sold. So that's now the normal, right? So there's not a very good chance prices will come back down to that $200,000 price range, because more often than not, in most areas, homes appreciate over time. They don't really depreciate. Now, that's not to say every area is like that, but a lot of areas are like that. So remember, marry the house, date the rate. Buy the property that fits your lifestyle and goals, and refinance when conditions improve. That's the strategy that you really need to embed in your brain. So how do we do this? Let's get pre-approved early and lock your rate strategically. Rate volatility is high during inflationary times, and rates can swing from a quarter to 0.5% in a week. I've seen this happen before, and maybe you have too. So once you find a competitive rate, lock it. Most lenders allow for a 30 to 90 day period to hold that rate. Ask about float down options, which can lower your rate if the market improves before closing. And you're probably wondering, well, what the heck does that mean? So without getting into a whole nother video, unless of course you want me to, leave a message below and we'll talk more about this. A float down option, sometimes called a rate lock with a float down, is a lender feature that lets you lower your locked-in mortgage if interest rates drop before your loan closes. It's basically a safety net for buyers, protecting you from rising rates and giving you flexibility if rates fall. And here's how it works. You get pre-approved. You lock in your rate with your lender. For example, say a 6.75% rate for 60 days. If interest rates drop during that lock period, say to 6.5%, you can float down to that lower rate. If rates go up, you're protected. Your original rate's going to stay at 6.75%. So either way, you win. If rates rise, you keep your locked in rate. If rates fall, you can lock down to get the benefit. So an example, say you lock in a 6.8% rate on August 1st for 60 days. By September 10th, rates have dropped to 6.3%. You request a float down rate from your lender, then reprice your loan to 6.3 before closing, saving you hundreds per year in interest. Let me know if that makes sense. Next step, let's strengthen your down payment and credit. Lenders get stricter when inflation is high. So to improve your odds, aim for 10 to 20% to reduce your PMI monthly costs. Pay down revolving debt and credit cards. Lower your debt to income ratio, because remember, this means better terms for you. Check your credit report for errors and optimize before applying. You want to have good credit. Credit is so important, especially when it comes to your rates. Look beyond headline interest rates. What does that mean? You can offset higher interest rates by negotiating. And some ways that you can negotiate are seller paid rate buydowns. Maybe the seller can contribute to temporarily reduce your rate. An example, a 2-to-1 buydown. Maybe you can get some lender credits. Some lenders will offer to cover some of your closing costs or points if you take a slightly higher interest rate. Maybe do an adjustable rate mortgage called an ARM. And this is good for buyers who are planning to move or refinance within 5 to 7 years. And if you're not planning to do that, it's not going to be a good option. So really think strategically through this, because remember, this is during a high inflationary period of time. Some strategies that you can use. An example, a 30-year fixed at 6.8% might cost you $1,570 per month, but a 7/1 ARM at 5.9 could save $150 to $200 a month for the first 7 years. And you'll have to ask yourself if this makes sense for you to do. Next, target stable or undervalued markets. And this is so huge. And this is one of those things that a good real estate agent can really help you understand when looking to buy a house. During inflation, local market resilience matters more than national averages because every market is different. Now remember, I live in Michigan, so we're going to talk about some Michigan stats here. Grand Rapids, Muskegon. These areas have strong job growth and steady demand. Matter of fact, Grand Rapids is one of those crazy areas that's been appreciating. Don't quote me on this, but I think it's like up to over 300% now since COVID. It's crazy. Newaygo, Oceana County, more affordable areas per square foot with potential for huge appreciation if you buy right. And then West Michigan waterfronts on Lake Michigan, there's very limited supply of these homes. It really has a built-in inflation hedge because everyone seems to want these properties. People are coming from all the way out west, down in the Chicago areas. They're looking to buy these homes because they're priced pretty fairly. And lastly, look for markets where supply is tight and employment is diverse. Those hold really good values. And everyone that's plugging into this, you know your areas. I'm talking about Michigan, my area. You may be from somewhere else. You know your market better than me. And then budget for rising costs. Remember, inflation doesn't just affect your mortgage, it raises the following. Home insurance. I'm sure many people who are buying houses right now understand this. Utilities and property taxes. And then we can all agree on maintenance and material costs. I mean, I know just from me speaking, it's so hard to do anything in my house because it's so expensive. So we can all feel the impacts of what these are doing to our bottom line. So here's a pro tip. Set aside 1% to 2% of your home's value annually for maintenance and cost increases. Let's move on. Think like an investor. This is a very pro tip. Even if it's your primary home, treat it as an investment. So does it have rental or Airbnb potential if needed? How many people when they're buying a house, are they thinking about this? Hey, if something were to happen, can I get cash flow out of my house? Idea. Could you add value, finish a basement, add a bedroom, update utilities? What's the 5 to 10 year resale projection in that area? Do you know this? Do you think about this? In inflationary times, assets that produce value or income outperform cash sitting idle. Everyone wants to pull their money and set it in cash during these times, but if you have assets that increase in value or provide cash, it can help you during these times. So let me give you an example. Again, I live in Michigan, so this is going to be an example to where I'm at. So here's the scenario. A $250,000 home in Newaygo County. We put 10% down, $25,000. So now the loan is going to be $225,000 at a 6.7% interest rate. The payment is roughly $1,460 a month, principal and insurance. If rates drop to 5.2 in 2 years and I refinance this thing, the payment will then be roughly $1,235 per month, saving me $225 a month. That's why timing your purchase beats trying to time rates, because we don't know when the Fed's going to cut rates. We don't know these things. However, we can always buy at our desired price. And if the home isn't selling for that price and it's been sitting for a long time, there's a good chance that you could come in and get that seller to give you what you want, because we don't know what's going on in that seller's life, but we do know what our bottom line is. So target that house and get the price that you want. Don't worry so much about the interest rates. So to sum all this up, let's talk about the principle and then why it matters. So the principle is focusing on the long term, not the short term. Inflation cools down over time, but homes hold their value, or they should. Doesn't mean they will. All depends on the area and how well it's taken care of. Strengthen your finances. Lenders tighten their standards during inflationary periods. So lock your rate smartly, okay? And this will protect you from volatility. One week the rates could be good, the next week they could be off the charts. So you want to lock your rate accordingly. Choose resilient markets. Local demand cushions inflation. And then think value and cash flow. Because remember, inflation favors assets that appreciate. If you're looking to buy a secondary home and you want to know what it costs in today's market, check out this video I made right here. I'm sure it'll provide some value to you. Thanks so much for stopping by. Please be sure to leave me a like, comment, and as always, subscribe. And I look forward to seeing you on a future video. Take care.